Trump administration's trade war with China and Mexico is having a huge impact on Nebraska farmers.
Nobody in history did more for the farmers of our country than I did. I got them $28 billion with a B, $28 billion from China.
As you can imagine, the farmers out here are very disappointed, to say the least, about that decision by the president.
Just minutes ago, major changes in global trade began hitting farming hard in the country. BRICS countries are shaking up the market, causing a sharp drop in prices for crops like corn and soybeans. Farmers are losing track of important information on prices and demand, while China buys more from Brazil, leaving American farmers struggling to sell. Can farmers survive this price shock and compete with the new BRICS system? Let us see how this global shakeup could bring U.S. farming to its knees. American farmers grapple with falling prices and rising costs. Right now, entire countries are making big changes to how global trade works, and farmers are feeling the effects. Prices for corn and soybeans are dropping, exports are going down, and China has stopped buying large amounts of wheat from the country. It's not just a small group of countries anymore. 12 more countries are either joining or thinking about joining a new global trade system that competes with the old country-based system. As more countries consider joining this new trade group, rumors swirl about a secret country that could change everything. In the past, the traditional system gave important price information. For example, when China bought 1 million tons of soybeans from Brazil, everyone could see it. But with China and Brazil now developing their own trading systems, they don't need dollars, Western banks, or the Chicago exchanges anymore. This change means we're losing important information about prices, supply, and demand. This is a serious problem for American producers, especially those in oil, mining, and farming. Every year, farmers worldwide have to make big decisions on what crops to plant. They rely on expert advice and futures markets to guide them, but the rules are now changing, and it's hard to keep up. In 2019, for the first time, there was a trade deficit in agriculture. Since then, it has happened 4 out of the last 6 years. This year, experts predict the biggest deficit yet. Once a global leader in food exports, it is now importing more than it's exporting. The trends are clear. Exports are going down, imports are going up, and it's not looking good. The American Farm Bureau is worried because corn and soybean prices have dropped by 30% in just 1 year. But exports haven't picked up as they usually would. Normally, lower prices would mean more buyers, but that's not happening now. China is buying more from Brazil, leaving American farmers to sell mostly to Mexico, their biggest market right now. The country had been the go-to financial system worldwide for 100 years because there wasn't any other option. But with new technologies like digital currencies and systems that allow quick, free transactions, a new system is emerging. The BRICS countries are getting close to finishing this new system, which could mean the traditional American financial system is nearing its end. But that's not all. It is also introducing policies that might make things worse for farmers. President Trump has talked about putting a 200% tariff on John Deere if the company moves its production to Mexico. The goal is to keep jobs and production in the country, but it could backfire in a big way. Trump said the tariff would apply to all John Deere products sold there, but only if he wins the election. This decision isn't set in stone yet, but the message is clear. It could be a big problem for American farmers and manufacturers. Moving production to Mexico helps companies cut costs because wages are lower there. But this shift also affects jobs. The situation doesn't just impact John Deere, it affects the whole farming industry. With demand already falling, John Deere has started laying off workers, and the tariff could make things even worse. But that's not the worst part. Farmers are facing record high costs. Fertilizer prices have shot up by 78%. On top of that, interest payments, maintenance, and transportation costs have gone up by about 20%. If tariffs make farm equipment like tractors and trucks more expensive, farmers will have to raise their prices. With debts mounting, U.S. farmers plunge into a desperate economic struggle. Agriculture's $32 billion struggle. This could lead to a domino effect. The higher prices will eventually hit American consumers. On top of that, the trade deficit in agriculture is getting worse. It's expected to reach at least $32 billion by 2024 because it is importing more food than it exports. This is happening because production costs are less competitive, putting the country in a tough economic spot. Prices are rising fast, making it more expensive for countries around the world to buy goods from the United States. Many are choosing cheaper options, like products from Latin America. A chart clearly shows that it's losing ground as a major food exporter. In 2011, it had its largest trade surplus at $44 billion. But by 2019, things changed. It was importing more food and exporting less, which is bad news for the economy and even poses a risk to national security. Donald Trump is concerned about this shift and is urging China to buy $50 billion worth of agricultural products. He plans to talk directly with President Xi Jinping to push for more American goods being imported into China. However, this deal depends on removing certain tariffs, and that hasn't happened yet. Plus, with food prices expected to go up, this deal seems even less likely to succeed. China, always looking for the best deals, is already making changes. This year, China canceled a large number of wheat shipments, turning down a massive 500,000 tons in just 1 week. This move suggests China is trying to rely less on G7 countries, mainly because of rising costs. On top of that, China prefers doing deals in local currencies, like those from Brazil or Argentina, instead of using dollars. This shift makes China even less interested in imports. But that's not the worst part. As China looks elsewhere, prices are going up and the trade deficit is getting worse. While this is happening, China is making big moves to boost its own economy. Their stock market jumped by over 4% in just 1 day, showing how big and strong their economy really is. The Chinese government is tackling its economic challenges on 2 fronts. First, it's focusing on boosting the real estate market, and second, it's supporting the stock market. The People's Bank of China has lowered its repo rate from 1.7% to 1.5%, pumping an incredible 1 trillion yuan into the economy. This huge investment is aimed at reviving the economy and stabilizing falling real estate prices, which is key because much of Chinese household wealth is tied to property. When property values drop, people feel poorer and spend less. But the real challenge is yet to come. By 2025, China expects a major trade clash with G7 countries. Restrictions and tariffs are already being put on exports like electric vehicles, and these could spread to other products like steel and plastics. By 2030, imports from China could shrink to just 10%, and if Trump's policies continue, it could drop even more. Yet the situation could get worse. China is fighting back by reducing its imports of American corn and selling off debt while increasing its gold reserves. This shift makes us wonder how farmers in the global economy will be impacted in the future. The relationship between the United States and China plays a huge role in global trade, especially when it comes to grains. Corn in particular is very important. It's not just a common food item, but also a key ingredient in many industrial products like corn oil, cornstarch, high fructose corn syrup, and even biofuel. Because corn is traded worldwide in such large quantities, it has become a vital part of the global food market. China is one of the largest importers of corn, while it is the top exporter. American farmers produce huge amounts of high-quality corn at competitive prices, which helps China meet its needs and build up reserves. But the trade of corn between the US and China faces many difficulties, such as trade disputes, tariffs, and changing policies. A clear example of this is the trade war that began in 2018, when China placed tariffs on corn, drastically reducing the amount of corn sold to China. This put a lot of pressure on corn farmers, cutting them off from a key market. At the same time, Chinese buyers started purchasing more corn from places like Brazil and Argentina, which made things even worse for farmers by lowering their sales even further. On top of that, China has been trying to grow more of its own corn using better farming technology in an effort to rely less on imports. There was some hope that things might get better after trade tensions cooled down. In January 2020, the 2 countries signed a preliminary trade deal where China agreed to buy more agricultural products, including corn. However, things didn't go as planned. As the presidential election approached, the administration shifted focus back to tariffs on Chinese goods, partly to support Vice President Kamala Harris. They imposed tariffs on a variety of Chinese products and discussed the idea of reducing the country's economic dependence on China. In response, China cut back on orders for soybeans and corn, turning instead to countries it had more stable trade relations with, like Brazil. This shift didn't cause food shortages in China, but did change the market balance. Countries like Brazil, which is part of the BRICS group, benefited from China's move. Meanwhile, it found itself dealing with more uncertainty regarding its trade policies, leading to potential disruptions. Its share of the corn market in China dropped sharply, from 31% to just 6%, almost eliminating its presence there. Now, a dark threat of inflation and debt looms over the American economy. Rising U.S. inflation and a potential debt default. It also faced issues with China selling off debt. China had already begun reducing its holdings of treasury bonds, and in July 2024 alone, it sold $3.7 billion worth. This left it with more debt and fewer buyers. Efforts to get Japan to buy debt again didn't work out because Japan also started cutting its holdings due to its own problems. At the same time, it is grappling with high inflation and has thought about lowering interest rates to ease the pressure on the economy. However, cutting interest rates could cause inflation to rise again, which is risky given the current economic climate. As officials talked with China about economic issues, their focus was mostly on debt and interest rates, trying to convince China not to sell off more debt. But these efforts didn't seem very strong, especially since it was still imposing tariffs and pushing to reduce economic ties with China. To put tariffs on many products from China and to say that China is supporting Russia in the Russia-Ukraine conflict points to a time of tension. In the United States, people are facing economic challenges, which is making them lose trust in the government. At the same time, the world is becoming less confident in the economy. Wall Street expert Peter Schiff recently mentioned that a government shutdown in October is becoming more likely, and the chances of a debt default and recession are also increasing. He emphasized that these issues were predicted, and now they seem to be on the horizon. The focus is shifting towards the federal government's growing budget deficit and rising inflation, especially after the elections in November 2024. People are nervous that no matter who wins the presidency, whether it's Donald Trump or Kamala Harris, their financial plans could make the debt and deficit problems worse, particularly with interest rates being so high. These high rates mean that paying the interest on the debt could make it hard for it to stay within its debt limit by January 2025. If that happens, it could default on its debt unless Congress steps in. But this isn't even the worst part. Nura, the biggest brokerage firm in Japan, issued a report on September 19th warning that a debt crisis could force the government to either delay or even refuse to repay its debts. This would shift the burden of deficits and put the economy at greater risk of a downturn. In light of this, Harvard professor Aditi Kumar suggested that gold could become the foundation for a new global digital currency system that would work alongside the dollar. Gold is becoming more important in the global economy. It doesn't carry the same credit risks as other forms of money and holds its value on its own. Recently, gold prices almost hit an all-time high at $2,580 per ounce on September 19th. This year alone, the price of gold has increased by 25%, reaching 26 new record highs. But the rising gold prices are not the only thing to worry about. Several factors are pushing gold prices up: a weaker dollar, concerns about the economy, less reliance on treasury bonds, major interest rate cuts, and central banks worldwide buying gold to diversify away from the dollar. Central banks have been buying gold at record levels. According to a World Gold Council report from September 10th, central banks bought 483 tons of gold in just the first half of this year. That's 5% more than last year, and the highest six-month buying spree since records began in 2000. Singaporean gold trader Ronan Manley noted that many central banks are following France's lead from the 1960s, bringing their gold reserves back home. These banks believe the decline of the dollar is inevitable because it is backed by debt, not gold. Recent data from the World Gold Council shows that by July 2024, the People's Bank of China increased its gold reserves by an extra 29 tons over the past year and a half. During this time, China's gold reserves grew by 36 tons, a 16% rise, bringing their total to 264 tons, which makes up nearly 5% of their foreign currency reserves, their highest percentage ever. But the rise of gold isn't the only significant change we're seeing globally. In agriculture, Brazil has seen a major shift in its corn exports to China. Even though Brazil's 2023 to 2024 corn harvest was about 12% smaller than the previous record year, its corn exports to China have continued to increase, playing a big role in global trade. During July and August, which are the start of Brazil's main shipping season, the country experienced a 29% drop in corn exports compared to the previous year. Experts believe this trend will continue for a while. Forecasts show that Brazil's corn exports for September may also fall, possibly by another 25% compared to last year. Even though there is a slight expected increase of 3.6% in Brazil's corn production for the 2024 to 2025 season, overall exports are expected to drop. This is because more corn will be needed within Brazil itself. Back in 2018, when trade tensions were high, Brazil built stronger agricultural connections with China, especially when it came to soybeans. As a result, it's now less likely that China will turn back to the US for large corn purchases if trade tensions rise again. China is trying hard to become more self-sufficient in agriculture and wants to increase its own corn production. But they face challenges like poor soil quality and needing better farming technology. Despite their efforts, China will likely still need to import a lot of corn for animal feed, but they may not buy it from the US at the same time. Another trade issue is arising, this time with Mexico, which is their second largest buyer of corn. Mexico plans to ban genetically modified corn by the end of 2023 in an effort to protect its native corn varieties. This could have a huge impact on corn exports because more than 90% of the corn grown there is genetically modified. But this isn't the only shift happening. In a bigger picture, China is working on reducing its reliance on the economy and the dollar. Part of this strategy involves buying less debt and investing in other things, like gold. As other central banks around the world are also increasing their gold reserves, the dollar's dominance is facing some challenges. The changing trade relations between it and China are not only reshaping their own economies, but also having an impact on the global financial system. Recently, China sold $3.7 billion worth of Treasury securities just after the Federal Reserve lowered interest rates. This move sparked a lot of debate among economists, policymakers, and investors around the world. People are now questioning why China made this decision and what it says about how they view the economy. But the real worry is what this could mean for the international financial system. As American farmers grapple with shifting global trade dynamics, falling crop prices, and rising costs, the landscape of international agriculture continues to evolve. Is the US ready to lose its dominance in the global food market? Share your thoughts below. Don't forget to like and subscribe.